And that brings us to our talk of the tape, whether this Fed rally has any juice left. For that, we turn to Lauren Goodwin of New York Life Investments. She joins me here at Post 9. Lauren, does it? We've had a nice rally. We're up another 2.7% on the S&P just this week. What now?
I think this is a Fed relief rally that the market's been waiting for 18 months, and I think it has legs. Now, my economic view is a little bit less constructive than that, and so I'm worried that where we are in this moment of Goldilocks is just that, a stop on the train towards a more difficult economic situation. But for the next several weeks, I don't see any opportunity for the data to knock the market off of this track.
So if the data is coming in good, and it is, it's been pretty benign, even the fourth quarter GDP estimates are going up, why are you worried about the outlook, the economic outlook?
Well, the fourth quarter GDP estimates are where we are right now, and the market reflects that, which is that things have been going well. There's been no sign of recession over the course of this year, but that's been in part because of liquidity surprises that have come in over the course of the year, including liquidity from the consumer. As we turn the calendar in the new year, I see more headwinds, mostly from the lagged impact of Fed rate hikes over the course of the year. And so that's an environment where, again, for the next few weeks, we probably see a broad range of risk assets continuing to perform well. I think we should use that opportunity to rebalance into sectors that might be more durable in the face of what is continued uncertainty for investors.
You're saying recession next year?
Yeah.
Is that so you use the opportunity to what? Get more defensive?
A little bit. I think there's a range of opportunities that take advantage of this cyclical environment we're seeing, which includes more defensive sectors in equity. It includes adding duration as a result of what we've been seeing lately. But there are also some structural themes that have come up over the course of the past year: artificial intelligence, digital infrastructure, that we think are likely to be more resilient over the course of the year that investors can take advantage of.
It's just hard to see right now when jobless claims are a little bit above 200,000. That's not a lagging indicator. There's very little stress in this labor market. So why are you more pessimistic about the economic outlook than most?
When it comes to what we're seeing in the labor market, while this economic cycle is different in a lot of ways, what we do expect to happen, consistent with past economic cycles, is that the labor market is strong really until we're already in recession. 9 out of the last 10 recessions, we've seen employment improve, even accelerate, heading into a slowdown. And so, again, employment tells us where we are now, and that is absolutely not in recession. I wouldn't expect the market to react to negative economic news until unemployment or earnings start to tick lower. For me, that number on the unemployment claims rate is about 275. So to your point, nowhere near there yet.
Yeah. So is the disconnect that you're seeing with the earnings expectations for 2024 if the economy turns south?
Couple of things. First, yes, with respect to earnings, no matter which way we slice it, expectations for 2024 look optimistic. While things are looking really nice right now, to me, there's not as many opportunities for clear upside from the earnings environment. And so we're concerned that those expectations are a bit too high.
I guess just on the flip side, if we do face a bigger downturn, as you expect, then doesn't the Fed just cut more? And won't the market cheer that on?
I think it's a good point, but we're getting that cheer right now. Christmas cheer, holiday cheer, Fed cheer. Where the story does start to change is when the Fed is cutting for not benign reasons, but slowdown reasons. Then the market is likely to respond to recession risk.
Let's bring